Hello, and welcome back to Nonprofit Auditor Points. I'm Irina Ryshkova, and I'm your nonprofit auditor. And I continue this series about Form 990. In the previous episode, we talked about public support test, why leadership should focus on reviewing the test periodically and make sure they do not fall below threshold, which is 33%. Today, we're moving into another important area of Form 990 that often creates confusion, a lot of confusion. And this is financial statements reported on the Form 990. Form 990 includes a lot of numbers, and some of them look very similar to the audited financial statements or the statements that you can extract from your accounting software. QuickBooks, Xero, Sage, etc. Form 990 has Part 8, Statement of Revenue, Part 9, Statement of Functional Expenses, and Part 10, Balance Sheet. Most nonprofit leaders, board members, executive directors are familiar with the financial statements. And especially if the nonprofit went through audit process or review process, or even just by reviewing monthly statements. Nonprofit board members and executive director understand statement of revenue, balance sheet, and statement of functional expenses. For that reason, I will not explain what each statement means. For those who might want to more refresh memories what these statements are, you can review my previous snaps where we discuss these statements in details. Instead, we're going to focus today on very common and important question. Why don't numbers on the Form 990s do not match audited financial statements, or even they do not match statements extracted from your accounting software? And the answer is they're not supposed to match exactly, because the IRS has specific rules and regulations how to report these numbers. Form 990 is not prepared under GAAP. GAAP stands for General Accepted Auditing Standards, Accounting Standards, General Accepted Accounting Principles, which very often used when we prepare audited financial statements. Form 990 follows specific IRS rules, and those rules intentionally differ from financial reporting standards in several areas. And we will go over those areas, and I will explain how they different and why they different. Understanding those differences hopefully will help board members and management read Form 990 correctly and avoid assumptions that there is an error where the error is not there. One of the most common differences relates to donated services and donated use of facilities. Under GAAP, which is used for financial reporting purposes, certain donated services and donated facilities are recognized as revenue and expenses if they meet recognition criteria. For example, in-kind donated rents, in-kind services by professional person, such as lawyers. They are recognized as revenue and expenses. As a result, audited financial statements may show significant non-cash, or we call it in-kind revenue and expenses related to those items. On the Form 990, however, donated services and donated use of facilities, such as rent, are not reported at all as revenue and expenses. They intentionally excluded from Part 8 and Part 9 per the IRS rules. This definitely creates a difference between audited financial statements and Form 990 totals. The difference is disclosed as reconciling items on a Schedule D, Part 11 and 12, which reconciles revenue per books with the revenue per Form 990. So they're not completely gone. They will be reconciling item on the Schedule D, Part 11 and Part 12. Another common difference involved unrealized gain and losses on investments. To remind, unrealized gain and losses, it's appreciation of investments or depreciation before the investment is sold, because we report investments based on fair market value. So every year, audited financial statements do report unrealized gain or unrealized loss if the investments go down in value. And under GAAP, unrealized gain loss include in revenue. On the Form 990, unrealized gains are excluded from revenue and again reported separately as a reconciling item. Once again, it's done intentionally by the IRS because the IRS separates realized investment activity from unrealized market fluctuations. So if nonprofit sells investment and realized gain, that is reportable. If it's unrealized gain, which is just because of the market fluctuations, it's not reportable for the Form 990. Again, the reconciliation for this difference is also appeared on the Schedule D, Part 11. Another common area where the Form 990 is different from books or audited financial statements, it's fundraising events. Under GAAP, again, audit or books, fundraising events are typically recorded at gross, meaning revenue recorded separately, revenue from fundraising event, and expenses recorded separately for fundraising event. The net result is the change in a net assets. On a Form 990, fundraising event is not reported at gross, it's reported at net. So revenue minus expenses, one number. This means that instead of showing gross revenue and gross expenses, Form 990 reports net result of event. As a result, expenses related to fundraising events may not appear in the Part 9. And that's why leadership cannot compare audited financial statements with the Form 990. And the question might be why we do not see revenue, but we see revenue for fundraising, but we don't see expenses for fundraising. Therefore, reporting of fundraising events may introduce another level of complexity because of the reporting gross versus net. Fundraising events also introduce another level of complexity on the revenue side. Under GAAP, all amounts received for special event, fundraising event, reported as a revenue. In the Form 990, revenue for special event, fundraising event, is split in various buckets. For example, amounts paid for goods or services, such as ticket sales, are treated as earned revenue and reported in a Part 8, line 8A through 8C. The contributions portion of the event, including donations, contributions, and access paid over fair value of the items, is reported separately as a contribution revenue on the Part 8, line 1C. This can lead to situations where the net fundraising event revenue reported in the Form 990 appears significantly lower or even negative, even though the event was successful. This because the contribution portion is reported elsewhere and it's not included in event net calculation. The important point for leadership is this. Difference between audited financial statements and Form 990 is often expected is explainable. That's why the IRS requires Schedule D, Part 11 and 12, which reconciles revenue and net assets per books to the amount reported in Form 990. This reconciliation schedule exists specifically so readers can understand why numbers do not match and provide the reconciliation. Experienced Form 990 readers look at these schedules before drawing the conclusions. Board members and management should do the same to understand and confirm that those reconciling items are true and correct. When leadership see differences without understanding the reconciliation, it can lead to unnecessary concern, mistrust, either to the audit or tax return. In reality, both may be correct. Form 990 and audit financial statements, they serve different purpose and they are governed by different standards. One is designed for financial reporting and assurance. The other is designed for tax compliance and public disclosure. Completely different purposes, completely different standard. Understanding these differences between audited financial statements and Form 990 is critical for leadership. When numbers do not match, it does not automatically mean something is wrong. In most cases, explanation is intentional and disclosed through reconciliation process. Knowing where to look helps board members and management read Form 990 with confidence rather than concern. In the next episode, we're going to move to another area that often raises questions and discomfort to board members and executives: transactions with insiders, which is reported on a Schedule L, Form 990. We will talk about who the IRS considered an interested person, what type of transactions must be disclosed, why disclosure does not automatically mean something is wrong, and why this schedule deserves close attention from leadership. Thank you so much. I will see you in our next episode. Be safe. Have a wonderful week.